I'm really excited about this panel. Today you're going to hear from some of the family office insights, some of their investment techniques. As I'm certain you could imagine, at Fairbridge, we're looking at hundreds and hundreds of deals a year, and we pass on the majority of them. Very rarely are we closing on deals. We close on about 1% of the transactions we look at, and that's even with deploying billions of dollars. So about 5 years ago, I made the transition to also start my own family office to take advantage of some of the more opportunistic transactions that we're passing on over at Fairbridge. At Fairbridge, we deploy capital on senior secured real estate. We like to be in first position, short-term, opportunistic real estate. I saw a bit of a niche where in my family office, I may be able to get involved on some of the more entrepreneurial transitions in real estate, maybe get involved somewhere else in the capital stack, maybe on preferred equity, mezz, subordinate lending. So for me, I'm anxious to hear on some of the insights on how some of the other family offices are investing. And what I was asked to do today is, rather than go back and forth with questions, if we could just go down the line and each of you just tell me your name, your firm name, what you typically invest in, any preferred investment structures that you prefer to invest through, and the types of investments you are looking for right now. So we can start with you. So if you could just tell us a bit about yourself. And please keep it to 5 minutes each so we have some time for questions as well.
We're a single family office, we're very much generalist. We'll take a little look at just about anything out there. At the moment, we do a lot in the healthcare, biotech, and TMT space. We're seeing a lot of good things coming out of there. For our investment strategies, we look at a lot of things, we look at anything, so we don't really have a preference there, but at this point in time, a lot of what we're doing is co-investments with other family offices. That's one of our things we like to do, is just build relationships there so we can work with them and gain some insight in any of those other family offices that we do work with. If we find something we're not the most, best experts in the space, healthcare, biotech, that's an area where personally my background's in engineering, so don't have a lot of that, but through our connections, we're able to get a lot of expertise in that to help guide us in the right direction. And I think that's about it. Trying to go through this quick here, get us back on schedule, so pass it down the line.
Thanks. I'm located here in Miami, single family office. My background is in tech, and I've had several B2B SaaS software companies that I founded and exited. And about 10 years ago, I started my own family office here in Miami. Very much generalist. Howard, Devin's dad, is a friend of mine, and that's definitely one technique that I use in my family office, is sharing deal flow. And that's really where I think many of the best ideas come from, is the network that you build with other family offices and multifamily offices and founders. Actually, some of the best deals I've found are through founders that I've backed, who show me other founders and other startups that I could invest in. My thesis right now is we invest in everything: real estate, private equity, but my passion really is in venture, early stage venture. My way of looking at things right now is barbelled. So I'm looking at really deep tech investments where they are the leaders in that space. Some of the investments we've done are in robotics, like Figure AI, which we were a humanoid robot, which is an early investment that we did, or Sandbox AQ that's in quantum, or we just did a recent investment in a company called ND Addicts that makes PillBot, which is a robotic pill that you swallow and it does an upper endoscopy for you at home. And then I'm trying to find assets that really can't get disrupted by that kind of deep tech, with AI and quantum. And those are difficult to find, to be honest. But an example of that would be, for example, we recently purchased Pacific Park at the Santa Monica Pier, which is an entertainment complex. Everyone probably knows the Ferris wheel there. It's iconic. And that's the kind of business which is a tourist destination, and it's been around for 30 years, very Warren Buffett style, kind of, toll booth business. Hard to imagine how AI, maybe I don't have a good enough imagination, to be honest with you, but hard to imagine how those types of things could be disrupted. But those are the types of things that I'm really looking for, out of the box, can give you alpha, and it's not just vanilla. So,
Great.
Hello, thank you for this opportunity. I'm Cliff Oberlin. We have a 102-year-old family office, the Oberlin family office, located here in Miami, and we're also in Ohio. Through the years, we've had 10 operating companies within our family office. We have 4 remaining today. 2 of them we started, built, and sold to multi-billion-dollar public companies. And something I did when I was chairman of a group called YPO, Young Presidents Organization, chairman of the Financial Services Network. We had 6,500 members around the world. I started a family office network, and it was made up of people who were selling their companies, and they wanted to know what the next step was. And it seemed like the next step, logically, was family office, but nobody knew what it meant. So I started a family office network. Today we have over 1,000 YPOers, which are pretty major CEOs of companies around the world, that are members of that network. And a few weeks ago, I was the speaker in Dubai at the YPO Global Business Summit, and there were 1,100 YPOers there from around the world, and I brought up some facts from our book that they found interesting. I just finished a book, Family Fortunes, How Family Enterprises Thrive Across Generations, and the interesting facts I think that they found most interesting is 77%, and this is from 400 family offices that we interviewed around the world. My co-author for the book, one of them was Robert Doherty. He's the dean of the Forbes School of Business. And we found that 77% of the founders of family offices want to build a dynasty. And this is where growth comes in terms of the family office. We found that 5% of those founders are involved in running the family office, only 5%. So most of the people running the family offices are not, at least the ones we spoke to, the 400 we spoke to, are not the patriarchs or the founders. And the other interesting fact, which has been brought up by my co-authors on the panel, is 80% of the inheritors of those family offices, they're wanting to co-invest with other family offices. That was a major theme we found in our interviews. Looking at our family office, we own real estate. Our tenants are a lot of times publicly traded Fortune 500 companies. We also do private equity VC, but we prefer the investments when we're investing in private that are close to private equity, closer on the scale than to the VC. We like them to be mature, and we like to know, where they're going before we invest with them. As I mentioned, we still have 4 operating companies, and when we're looking to invest, what we do is this family office network I'm telling you I'm in, and I met some other YPOers at this conference that are in my forum. We have forums of 8 people. We get together monthly, and we have conversations, and in those conversations, we usually all need to bring in deals that we see. And we go through and we vet each other's deals before we invest, and we also then co-invest in those deals. And that has probably been the most enlightening for me, and it's terrific to go back to your family and say, have other families that are interested in this or have brought this to us or really are going to co-invest with us. It brings a lot of comfort to the family. And I think that's probably my number one. They ask for $1 million insight. Is what I've learned is try to get a network of other family offices if you're a single family office, and then network with them, co-invest, and the returns will be phenomenal. Something we had a lot of success with recently, one of our last speakers here, medical devices, a medical device company that we found through this group and network that we're in. So things can work out quite well. That's our family office, and thank you.
Sylvia?
Thank you. My name is Sylvia Solet. Some of you may have seen me speaking here under my unmarried name, Sylvia Benito, when I was at a single family office. That was last year, and this year I'm now Sylvia Solet, and I am working with a group called Prime Quadrant. I joined Prime Quadrant because they are a family office consulting group. They're primarily based out of Canada. Every major family in Canada has a relationship with them, so they have about 70 families on the platform, advising approximately $22 billion in assets. But it's a pure consulting model. So I know a lot of you are used to hearing somebody stand up here and say that it's a family office, but they're really just an RIA that's acting like a family office. We don't custody or gather assets. We are truly like a fractional CIO, CFO reporting. So we really come into any family office to provide a service that perhaps they don't want to build in-house. That's what we do. And now we're expanding into the U.S. market, and so I'm helping with that initiative. So I see a broad range of families, and like everyone says, every family office is different. But one of the common themes that I'm seeing that I thought I would share with you is I think people have a lot of venture fatigue right now. People maybe overweighted venture slightly because it was very appealing, or it looked very appealing a few years ago, and now because of the stagnation in the IPO market, you're seeing that exhaustion come in. And so the antidote to that seems to be cash flowing businesses. And there's a huge appetite right now for stable, unexciting, cash flowing businesses, and some of the most interesting deals that we're seeing out there are roll-ups of businesses that you wouldn't expect. For example, I recently saw one that was for self-service laundromats. I would never have thought of a roll-up of a self-service laundromat. It's a very appealing business model, actually. Doesn't require a lot of staff. The cash flow is consistent. So we're looking at those kinds of opportunities. And if I were to share sort of $1 million insight, it's really not so much in the realm of deal flow, but it's going back to what you were speaking about, which is the creation of legacy. And what we're doing right now as a company and as a team is we're really asking ourselves, what does legacy mean for our families? And more what we're seeing is that families are really looking for transformational experiences. So what does that mean? It's like it's not enough just to have the money, and in some ways it's not even enough just to grow the money, but to also have a team around you that can help you to understand, what does the money itself mean? How does the money move through your family? How is it impacting your family? And so we've begun to put consciousness as sort of the top of where we're trying to bring every family to. So my $1 million insight is that we should all be asking ourselves and engaging as family offices in what kinds of experiences will help us to become more conscious about how we deploy that money into the world. Because without the consciousness, it's just deal after deal after deal. It becomes kind of meaningless at a certain point. Like, I like my shoes. I don't need 1,000 pairs of them.
Yeah, it's a great point. I like the point that everyone made about co-investing and participating with other family offices. I know personally, I love co-investing with other family offices. Number one, it helps a lot with deal flow, and it really helps in understanding and learning how other family offices are looking and underwriting certain transactions as well. But I'm curious, I've noticed many of you are allocating capital into many different areas. And I know, just my own personal opinion, I've been in real estate for over 30 years. And every time I get involved in some other crazy venture capital or something else, I get hurt. So I'm at a point now where I'm just doing real estate. It's what I know. I know how to make money in real estate. How do you get comfortable in other asset classes? And this is for anyone on the panel. I'm curious.
That's when you know you have to double down on venture.
I don't know.
It's when you really feel sick to your stomach about it, and everyone hates it.
Yeah, it's tough.
That's the time to buy when no one else wants it.
I think Cliff made a great point.
Deals.
Cliff made a good point when you said at certain stages in a family office career, you're more about wealth preservation rather than creating wealth. So that's where it becomes a fine line. Like, are you better
Well,
off in?
I have an argument against that. Sorry, I didn't mean to interrupt you, but wealth preservation is growing your wealth because, I mean, I just watched Michael Saylor speak at the Camden Family Office meeting recently, and you know, I heard him speak like 2.5 years ago, and everyone thought he was nuts, and now they're taking notes. And the reason why is that he's been right about how much, you know, wealth erodes. And again, you want to build dynastic wealth for generations. You know, you can't preserve, you have to grow. Because I don't think the human mind really understands how fast the dollar, you know, the purchasing power of your dollar really erodes over 100-year time span, because you're not really, you know, he made a really good analogy, actually. I was at his home. He said, you know, I just got my home appraised for $46 million. In 1920, a family came here and built it for $120,000. If they took the $120,000 and put it into a shoebox and buried it into the ground and then gave it to their grandkids right now, they wouldn't even be able to buy a square inch of my driveway.
Wow.
So just think about that. You know, I actually think wealth preservation is wealth erosion. So that's my point of view on things.
Cliff?
What I've learned is to have a group around you, a confidential forum type of a group, where you can actually bring the idea, and then I brought in what I thought were some phenomenal ideas, and they bring up the experiences that they've had in the past where it didn't work. A lot of trains I didn't see coming at me. So I think just having a group you can take it to can in addition to have them bring you ideas, but you can have them vet your ideas, can make your investments a lot more secure.
Good point. So before we end, I just want to open it up to questions. Any questions from the audience for any of the panel members?
I want to know what a typical check size is in your investments.
No.
All right.
What is a typical check size in your investments?
For us, there is no typical check size. It varies up and down. As they were speaking earlier today, a lot of times we will like to start off smaller and grow our positions over time. Some funds and things have steep minimums that you want to meet, but they're the right place to be, so you're willing to go up to that. It's really just where we are at the time and how confident we feel in it, and what we have available as well. Sometimes things get locked up in some illiquid investments. That takes a while to get your money moved to the right place.
I agree with that. Actually, I get asked that question a lot when I'm being pitched, and I hate that question, to be honest. It's ridiculous because I'm going to size it based on how convicted I am on this investment. And so there is no typical check size. It's not like a formula. So, I guess some family offices run like that, but I would be hard-pressed to find a single family office that does.
Yeah, but I think, wouldn't you agree that there has to be some sort of threshold to make it worth your while? I mean, I'm sure you're not going out looking at a $200,000 deal. I mean, maybe you are, if it makes sense.
I am, because to be as a practical matter, if I'm doing a pre-seed round, I can't do a check bigger than that because they're not raising that much money. And so if I want exposure to that kind of asset class, then I have to write smaller checks. So, or if I'm doing a crypto investment, or if I'm doing some other kind of investment that I want to learn about, or I want to, do an initial step in, why not?
All that risky stuff, I get it.
And that's where co-investing can come into play also. When an investment comes and it's higher minimum, then we would consider as a family office, if it's something that is really interesting, we take it out to our forum or our group and come back, and then we'll end up doing a club type of investment, an SPV, where we all go together and put our money in. And that way, because a lot of these, they want to stick their toe in the water with an investment before they actually end up investing a lot more in it when it's a new idea.
Great.
We syndicate. So our last syndication was for Collar Capital. That was a 9-figure check. So our syndications tend to be larger. But as an individual investor, I definitely do smaller check sizes. And, like you're saying, you never know when they're going to pay off. Everyone thought I was crazy for investing in psychedelics. And now we have RFK, who's going to. So you
That's
never
right.
know.
You never know. Any other questions? I think we have one in the back.
This question is for Shane. You mentioned you like deep tech, robotics, and AI. What do you like about robotics, and what trends are you seeing in the market right now?
So I think the theme of robotics is that the TAM is really big. If you think of human labor, for example, it's like, I don't know, worldwide, it's like a $30 trillion TAM. It's actually the largest expense is payroll. And there's no reason why a warehouse worker should be going and picking and packing in an Amazon warehouse. It makes no sense. Like, humans don't like to do that kind of stuff, right? They get injured. They shouldn't be taking a sheet metal and putting it in a press all day long. These are jobs, first of all, that can't be filled. So it's not like you're taking other people's jobs. And B, I don't think people really want to do it. And that's why you see factory workers and warehouse workers getting paid more and more. So the opportunity, especially in what's called a robot as a service model, where you pay yearly, for a robot like $100,000 a year, a robot that can work twice as long as a human and doesn't need to take breaks, really will be a huge market. It's an untapped market. It's almost like the car market, right? Like, no one really understood how big the car and truck market really was. It's just not there right now. And it could be huge, and it has other ramifications for the economy and society in general. But from a business standpoint, that's really asymmetrical in my opinion. The idea that you have this huge TAM that can be fulfilled through robotics is the bet that I want to take.
Any other questions? I think we have time for one more in the back. What, 2 more?
All right.
Oh, we have 5 minutes.
Okay. Question. For real estate investments, I guess some of you guys that do that, are you looking for debt, mezz, JV, equity? What's kind of your appetite for that, and what do you look for in an operator or an opportunity?
I'm not happy to answer it unless someone on the panel wants to take a shot. But personally, when we're looking for real estate investment deals, I made it a point to build Fairbridge without having any specific parameters. I don't have a basket. I don't have parameters. I'm not sitting there saying, oh, this deal has to fit in this box, this LTV, this type of sponsor. Everyone in my company is a real estate professional. We understand real estate. If the story makes sense, if I like the sponsor, if it's in a good venue, good jurisdiction, then we'll do that real estate deal. So we're not looking for anything specific. I don't want to sit here and say we're only doing stabilized multifamily. Everyone's looking for stabilized multifamily. We're looking for good sponsors who have a good story to tell, a good project. And as long as we stick to the basics of real estate, the upside always takes care of itself. And if you're in real estate, you know the basics. Just find good sponsors and good jurisdictions and at a good basis. And like I said, the upside always takes care of itself. So I don't mean to give you sort of a roundabout answer. It's just personally, we're not looking for anything specific. I think there was one more question in the back. Oh, I'm sorry. I apologize.
Short answer, with us, it's all about the story.
Yeah.
We have to hear the story, and then the family wants to hear the story. If they believe in the story, then an equity type investment may work.
Yeah. Yeah, it's a great point.
As a practical matter, I'm doing mostly pref equity and some debts.
Yeah, just one more comment, because Cliff and Shane are 100% correct. It's all about the story. Like, I've already been pitched at the conference about, maybe lending debt on a real estate deal where the sponsor has zero equity involved, 100% LTV. Like, these deals make 0 sense. Don't come to anyone investing in real estate with those type of deals. Like, have some equity, have some skin in the game. The story has to make sense. I don't want to hear that you got a phenomenal value and you bought it at a 50% discount, therefore you could borrow 50% more with no money in the game. I mean, I hear this all the time. So the story just has to make sense. I think most of us have been in the business a bit too long where we understand it. Oh, I'm sorry, we had one in the back and then up here. I could hear you.
So thank you. I'm wondering how you guys avoid becoming lemmings. So I've seen venture capitalists, private equity investors for 20 years take this mindset of following each other off the cliff. And I'm just wondering, because, as an entrepreneur and, also an investor, I loved, Shane, your comment about, sort of looking at things through the opposite lens. But that's a real problem with investing. How do you address that?
I'll go first. I'm married to a long, short, neutral hedge fund manager. So that's awesome. If you watch the shorts, that helps a lot.
I think you have to, just like you do equity investing, right? You really have to look at it the same way. You have to have your own investment thesis. You have to understand what you're investing in, and you have to do your diligence. It's not like I don't just jump into every deal that maybe Howard's office is doing or some other office is doing that shows it to me. I definitely prioritize looking at those because I respect the other family offices that are looking at them, and I think that they've done their own diligence. But you have to build your own style, and you also have to size in a way that if you mess it up, which you inevitably will, you're not out of the game. So,
A lot of us are sales people by just the way we're built. And the easiest person to sell is another salesman. And that's why you need to have a group with a jaundiced eye you can take it to that's going to come back and tell you what can go wrong. Because a lot of times you just look at the positives.
Yeah, it's a great point. We had one more question, time for one more. I think it was over here somewhere. Who had that question? Oh.
Hi, hello. Hello. I'm Marek from London. Question to Shane. You mentioned that wealth preservation is really wealth erosion. You also mentioned the purchasing power and the dollar power is eroding. So given this, so what do you think the ideal returns for guys like you should be like, and where those returns can be found in terms of sectors, geographies?
I think everyone should answer this question because they have their own unique point of view. I actually believe Michael Saylor, to be honest. He makes really compelling arguments about crypto and Bitcoin in particular as being a store of value. And he doesn't sound crazy anymore, especially with this new administration and what's going on. If you are in a foreign country, right, and you are a multimillionaire, like in, I don't know, in the Middle East or in Africa or, an unstable country like that, it's the only way to store value, move your money into a store of value that you can actually get on a plane and leave with. It's not homes, it's not cars, it's not gold bars, it's nothing. All of that can be taken away from you, but crypto can't. So this is a big argument that a lot of people are making. I'm not saying to go sell your stuff and go Bitcoin maximalist, but I think that family offices should be really taking this seriously. I think that you should consistently invest in venture. If you look at the biggest endowments, because they have 100, 200 year time horizons, they have outsized allocations to venture because that is the only way It really is the only way to preserve capital, because you have to have a part of your portfolio that really does better than 8%, right? Because the last few years showed you that, right, with inflation. And so, that's my point of view on things. It's easy when you're a $1 billion family office to sit on your laurels, right? But it happens a lot faster than you think. So you definitely want to take more allocation towards things that are maybe riskier or more volatile. Let's put it that way, more volatile for the long term.
You have something to add, Sophie? Or we only have about a second left.
I've been going to crypto conferences for more than 7 years, and I never would have stood on a stage and said that now's the time for family offices to really start to seriously allocate, but it's time.
If you are a founder, raising capital, developing real estate, or you're an investor, we'd love for you to get involved in the Family Office Club. I've run this community for 18 years now. We've hosted 300 live events. We have 17 million social media group members and followers. We have the #1 YouTube channel on family offices. We have the #1 most popular podcast on family offices. You can learn more about us and our membership options at familyoffices.com. We have 30 in-person events planned in 2026 and another dozen events this year. Please go to familyoffices.com to learn more.